Actually, I probably won't need my notes. I'm talking about a market on the move. I should get away from the podium. Good to be back. Thanks for having me, David. It's a pleasure. And we've heard this before, what a difference a year can make. And we've seen so much data today. And actually, you find myself in a real dilemma. We are, as managers and as financial advisors, financing advisors, we are numbers guys. We like statistical evidence, probably most of you. But in this year's studies that we've been doing, we find a lot of disparity. We find a lot of numbers that at first glance don't seem to make sense. And at first we've been struggling with this a bit, but there are some good news in this as well. And with all the numbers we've seen already today, I'd like to step a little bit maybe upwards and take a higher, maybe a bird's view when we talk about the German market and talk a bit about sentiment that we're seeing and where, depending on whom we ask about their sentiment, what different answers we're getting. If we start with what JLL and at ZEW do in their index, we see numbers that are very similar to what we've seen in COVID lockdown period 1, Q2 2020, with a very pessimistic or restrictive lending environment in Q2 of this year, and also a very negative outlook overall. So things that I think we've heard from economists today that we can easily explain. If we do a different look, and this comes from our friends from BF Capital together in their quarterly barometer that they publish with Ingesa, and they suggest we are in a credit crisis. If you see this, and again, you've got numbers that compare it also to the quarterly results in 2020, a very similar situation where lending almost came to a stop in the beginning of COVID, with everybody starting to really wait what's the next move on the debt market. Now that said, it didn't make sense for us when we did our study, and this year again we've asked about 50, and that's maybe the small difference, lenders in the subordinated market. We talked to those that are classically not the banks, it's more the credit funds, the debt funds, it's family offices and institutional investors like many of yourselves. And if we look at those findings, we were puzzled. We got a lot of very positive, strong messages. Now, the question we ask is a slightly different one. We don't capture the actual activity in that moment. The question is, what's your outlook for your market in subordinated loans over the next 12 to 18 months? And if you look to the very right, the strong bar, 53% have been even stronger than optimistic. If you add those that said, I expect a positive development, you're getting close to 90%. So that's the strongest measurement we've seen in this market.